Boom! Alright, what's up you guys? It's Royce Jacob. Welcome back to the channel. In this quick video, I want to talk to you about why it's important to experience downtimes like these as a trader / investor. I also want to talk to you guys about the nature of the correction and or crash that we are seeing today in 2022 and how this crash compares to those that we saw in 2008 and 2000. I'm sure you guys have heard a lot of analysts at this point compare what we're seeing today to what happened during the housing bubble, during the dot-com bubble. And I just want to talk to you guys about the very evident and pretty obvious macroeconomic differences between what happened in those two scenarios and what happened today, and why it makes me a little more optimistic on the fact that this won't be as bad and as prolonged as what we saw once again in 2008 and 2000. And then last but not least, I want to talk to you guys about why you'll be very rich. You'll be a very rich individual in the case that you can cool down and act and think rationally in a market full of so much emotion. Okay, so that's the video, you guys. Gonna keep it short and sweet. This one's not super in depth, not gonna be going super deep into anything, more of a thought experiment. But again, this is a very psychological environment. There is a lot of game theory at play right now, and I just kind of want to talk to you guys. I want to talk you guys through my general thoughts on the macroeconomic environment and just kind of my general thoughts on the market and how I'm currently navigating this these very choppy waters. Okay, so that's the video. Let's quickly go over the tabs I want to share with you, and then we'll dive into each one individually. We'll close it out actually talking about the differences between the dot-com bubble, housing bubble, and what we're seeing today. You call this the financial crisis. But you guys know when, if you guys watch The Big Short, you guys would know exactly what this means when it reads housing bubble. Okay, on top of this, we will revisit the good old fear and greed index. I just want to talk to you guys, and I'll keep referencing this for as long as I feel necessary, and it's arguably more necessary now than it has been in a very long time. And that is because when others are greedy, you should be feeling fearful. When others are fearful, or extremely fearful at that, you should be feeling greedy and or exceptionally greedy. Okay, and right now, from a definitely actually a short and long-term perspective, that'll make sense as I clarify that over the video, I am feeling exceptionally greedy. The medium term is a little bit iffy, but short term, I'm feeling greedy. Longer term, I'm feeling greedy. Medium term is a little up in there. But again, I'll try to elaborate on that a little more over the course of the video. So we will reference this, you guys. Whenever there's extreme greed, whenever there's extreme fear, you should be feeling at least a little bit greedy, okay? And that is definitely how I'm feeling at this moment in time, because we are still in single digits, okay? So that's pretty much the sum of the video. Again, you guys, we're just gonna be, I'm really just kind of winging this one, just talking shop with you guys. So to kick it off, I do want to read the intro to the newsletter that I sent out this morning. Date of recording is Tuesday, May 24th. But again, just cover the basics of my current macroeconomic view, why the crash in Snapchat we just saw is very representative of the fear that's present in the markets right now, and why I think, again, this fear will mitigate, and if you can capitalize on this correctly, you will find it to be a very lucrative venture. Okay, so let's get reading, and then we'll dive into these other two talking points. One step forward, two steps backwards. This seems to be the unfortunate truth of the markets as of late. At this point, it seems like investors are just waiting for the next piece of bad news. As we've mentioned, Snapchat came out yesterday admitting they would fall short of their earnings targets, which has created for a wave of fear across the entire market today. Tech is getting hit exceptionally hard. Snap's primary stream of revenue is advertising, so it doesn't make rational sense for all of the tech stocks who aren't relying on ad rev to be seeing pain. But the thing is, this market isn't rational. So again, Snap today fell 40%. But the NASDAQ, pretty much every stock in the NASDAQ fell significantly as well. Obviously, Tesla down like 7%. A lot of the great growth names that we've been talking about lately down double-digit percentages. And again, this really speaks to the fear of the markets right now, and the fact that investors are really just looking for any excuse to sell if they haven't already. But again, the sellers at this point, in my opinion, from what I've seen on the tape as well, the sellers seem to be getting exhausted, okay? Especially when it comes to these growth names. Names like Roblox and Unity, speaking of great growth names, are great examples of this. Advertising revenue isn't relevant at all to these two, and gaming activity, therefore revenue, will inevitably spike this summer. Kids go on summer break. Gaming I mean, you guys, gaming is the ultimate escape, especially during a recession when people are getting a little sad, not feeling the best, unfortunately a little depressed. You're going to turn to games. Gaming is the ultimate escapism. So gaming, I said this in part 2 of the newsletter actually, is the ultimate form of escapism, and I do think gaming is recession proof. That's why I've been talking a lot about Roblox and Unity lately. Yet they're both down double-digit percentages. I mean, Roblox down like 11%, Unity down like 14% today. That's bonkers. I did capitalize that, just to let you guys know that now, due to the fact that tech investors continue to quiver and run at the mention of any negative news. This market remains very afraid and very emotional. Our trusty fear and greed index is back in the single digits today, currently sitting at a 9. Although things seem extremely bleak today, these constant levels of extreme fear simply aren't sustainable, and I believe some extended relief will come sooner than later. So again, extreme fear, we've been bouncing this territory for, let's reference that right now, we've been in extreme fear and levels of extreme fear for, I mean, pretty much 2 weeks now, over 2 weeks now. And if you've seen in the past, it's very, very rare that we spend a significant, like this significant of a time in extreme fear without reverting to the mean. And I've been saying this a lot in the newsletter, been referencing the fear and greed index in the newsletter every morning, because I feel like a good sign of the shorter term relief rally will be a reversion to the mean. In this case, again, the macroeconomic backdrop is still uncertain. The economy is still objectively not in a good place by any means, but there's no reason for us to be in a zone of extreme fear for a prolonged period of time, 4 weeks at a time, for months at a time. And we're going on pretty much a month now. So I do think we do need to see a reversion to just the standard levels of simple fear, and I do think on top of some technical indicators that we won't be covering today, but of course covered that in the newsletter as well. On top of reclaiming fear, there are some just bounce targets and just things that lead me to believe that there is some short-term relief in play right now. Again, medium term, when it comes to the rest of the summer, is very uncertain. But and long term, obviously the stock market's going to go up. That's what we're seeing here. Just over long periods of time, the stock market will continue to go up. That's just the nature of the beast. But medium term, uncertain, short term, bullish, long term, always going to be bullish. Okay. So keep reading. When there is so much fear and emotion in the markets, it's especially important to keep a cool head, stay rational, and stick to your game plan. I'm proud that we did that today. Although the portfolio was down overall, those Tesla puts mitigated a lot of the losses from our longs, and the profits that were taken contributed to buying some great companies during the irrational sell-off. So again, Tesla puts been printing on days like these, right? I think these specific puts that I had were up like 40-50%. Take some profits for that, put them into some calls I have that are down 40-50%. And that's just, I mean, that's really how I've been navigating this environment personally in my personal portfolio. So even in the case that you're bullish, the responsible move, especially if you're playing options, is to stay hedged in the case that we get thrown a curveball. And today we were thrown a curveball on fire. Obviously, days like today aren't as enjoyable and motivating as the days you're printing money, but they're far more important from a macro perspective. You need to take on choppy seas to become an experienced sailor, and these waters are about as choppy as they come. Those who make it to the other side of the storm will be much stronger and richer on the other side. Stay strong and stay learning, team. Resilience pays off. Okay, so again, you guys, it's important to experience times like this over the course of 2020, 2021. When everyone was locked down, everyone was on Robinhood, everyone became a day trader, which is obviously good for the channel. Good for, I mean, it was a fun time. It was a fun experience. But the reality of that, and on the bright side of it just being a fun time and everything going up, just good times rolling, on the bright side, it did introduce a lot of individuals to the markets. It created for the desire for education in financial literacy, and it made a lot of individuals a lot more financially literate. Unfortunately, this past 6 months has also obliterated the savings and the morale and demeanor of a lot of the individuals who got introduced. So it will take some time just to regain that optimism and regain kind of that momentum in the markets. A lot of retail is probably never going to get back into the markets because they got so smoked and scarred this year, which is unfortunate. But long term, again, this was good, but again, we're seeing just a lot of the negative repercussions that come with such an emotional environment. Again, emotional and manic and irrational on the way up. You're gonna experience those same emotions just in a negative format, in a much less fun format on the way down, which is what we're seeing now. Okay, so again, you guys, I do want to let you guys know that if you want to know how I'm trading on a day-to-day basis, if you want to know how I'm updating my personal portfolio, when I'm entering a position, when I'm exiting a position, all my calls, all my puts, stock positions, crypto positions, a complete breakdown of my personal portfolio, which is updated every trading day. And with every update, of course, I do send out a few of these bad boys. This is just one of the 3 newsletters. Each morning, I kick it off with a trade alert newsletter. Let you guys know what I'm trading. That is the most time sensitive, in my opinion. Okay, let you guys know what I'm doing as soon as I'm doing it. That's the first. Next one is this puppy. Nope, this puppy right here, the more extensive macro newsletter. And then part 2 right here, which I send out last, is individual analysis. So all the stocks that are relevant to the portfolio, Bitcoin, render token, whatever growth stocks we're covering that day, that I'm trading that day, throw in a chart, throw in price targets, and throw in kind of a fundamental analysis as well. Okay, that was the case with like Unity, Roblox, Bitcoin, SoFi today. So if you guys want that, there is a 7-day free trial that will be going till the end of the month. So go check it out if you've been thinking about it. Just give it a free shot. If you don't like it, just unsub. But I trust you will be sticking around. I work very hard on this, and I feel it's more than worth it. If you stick with it, this will pay itself off many lifetimes over probably. So give it a shot. It means a lot if you guys do. If not, no worries at all. That link will be the first one in the description box below. So again, I feel zero guilt recommending this because I work very hard on it, and I do think you guys will like it. So that said, let's dive into pretty much cover the fear and greed index. Again, I covered this in the last video, so I won't go too long on this. But again, you can see we do not spend much time in extreme fear without reverting to the mean of just fear. So again, in the past, you guys can look here. We can spend like over here. We did go sideways, bouncing between extreme fear and fear for a while. But we did ultimately bounce between fear and extreme fear. So again, we're oversold right now. Everything's oversold. Everyone's extremely fearful given, again, Snapchat was down 43% today. Off not even terrible news. They're still growing. They're still hiring. They just said they weren't going to meet their expectations, which they probably just overshot for themselves in the first place. So they probably overshot their expectations. It's probably not going to be terrible. It's not going to be good, that's for sure, but it doesn't warrant a 43% sell-off. Okay, that's just bonkers. And again, that's a sign of retail investors just being super scared, and hedge funds also being scared on top of having to liquidate their portfolios because they're probably over leveraged. They're probably trading on margin. Options calls, our call options are just getting absolutely obliterated. And this is what happens when we're seeing kind of the 2022 version of a liquidity crisis. It's honestly just a lot more emotional and a lot more depressing almost. But anyway, if you can play it correctly, again, thankfully the home team today was a little rough, but that's why we stayed hedged. Home team played it pretty well, and I'm very proud of how the portfolio has been structured. So last call to action, check out the first link in the description. I'm posting a lot less YouTube videos these days as well, just because I put so much time and pretty much all my thoughts in the newsletter. That's really why I read through them in pretty much all my YouTube videos lately. So again, you guys, during times like these, it's important to stay tuned. But making YouTube content, there's really not much, definitely not daily content to make. I will still make 2-3 videos a week. Always going to be here for you guys and give you guys almost like TED Talk, PSA videos like this. Also just because it's enjoyable, and again, it's good to be stick as a team. But again, you guys, if you want the day-to-day content, you want to know how I'm trading and actually doing this, dash the newsletter. Okay, so that said, let's quickly talk about the differences between what's happening now and what happened in 2008 and the dot-com bubble to close it out. Okay, so today, obviously the big thing that's happening today, or the primary reason that we're seeing sell-offs in the markets, number one, is interest rates are rising. Okay, don't fight the Fed. That was the cliche. That's what everyone was saying as stocks were going up from here. Boom, bottom of the pandemic low. As soon as the Fed started printing money, you don't fight the Fed. As soon as the Fed fired up the money printer, as soon as they started purchasing equities, they were buying. Again, the Fed just went in with their balance sheet, bought the S&P. They were literally pumping up the markets, pumping up the equity markets, stimulating companies within the U.S. economy. And that's why we kept just going up. Now, the Fed has stepped on the brakes, and they're not just popping a nice U-turn. They are stomping the brakes And I mean, pretty much just throwing it in reverse. They're not even hitting the brakes. They're just throwing it into reverse. They're just jamming that manual transmission and going in reverse. Okay, they're stepping on, or they're brake checking. Okay, you guys get the analogies that I keep ranting about. But we're doing the exact opposite now. That's why we started saying as soon as the economy started slowing down. That was a red flag, obviously, right? People getting stimmy checks, people getting unemployment checks, just kind of having a reckless abandonment for their capital because they haven't earned it. Just spending like there's no tomorrow, just spending like they're not earning their money, which was what's happening. Putting it all into the markets. As soon as the party stopped, as soon as we topped out and that turned around, people started losing money. You lose money. You're not getting the stimmy checks anymore. You're still spending like you have that money, like you have expendable income when you actually don't. Inflation is rising. Gas prices are rising. The cost for necessary goods is rising. And that's a terrible combo. But that isn't, aside from inflation and the Fed again is tackling that. The US dollar is doing just fine. The Dixie's just fine. The dollar is not going to crash or inflate to nothing, of course. But the underlying, the backbones of the financial system are not really broken. So that's what happened during the housing bubble. Again, the economy is bad. The economy is definitely going to slow down, but there's no reason that we should crash because there is still a lot of, the dollar, the Dixie is still objectively strong. The dollar is in triple digits, and that's good news for the US dollar. The Dixie, the dollar, the Dixie is the US dollar weighted against another, a basket of international fiat currencies. Okay. So Dixie, the US dollar is actually strong, contrary to what a lot of people may believe. People have been finding safety in the dollar over the course of this crash. Okay. So again, the economic backdrop is pretty bad. Inflation is real, but it's not broken. The system isn't yet broken. Maybe it breaks down the line, but not today. Okay. During the housing collapse, the banks went insolvent. So they were giving out mortgage loans that people couldn't pay off. Go watch The Big Short if you haven't. It's a great movie. Okay. I was feeling like Michael Burry over the short in Tesla over these past couple of weeks. But anyway, go watch The Big Short if you haven't. Great movie. Little content recommendation. But again, the housing bubble, the banks, because of terrible incentivization practices, like those who sell the mortgages, those who deploy the mortgages, we're getting commission on that, pretty much caused everyone to just give out terrible mortgages to people who obviously could not pay them off, and terrible, almost non-existent credit scores. They got mortgages, they couldn't pay them off. The banks went insolvent. Okay, so that broke the banks. That's why the government had to bail out the banks. Okay, and that's whether they should have gotten bailed out or not is up for debate, but that's what happened. That broke the financial system. Today, the banks, JP Morgan Chase, Jamie Dimon of JP Morgan Chase, just came out yesterday or the day before that talking about how JP Morgan is in great shape, and they're probably going to beat on revenue, beat on all metrics over the coming quarters. When banks are healthy, that is a good sign that the underlying economy is healthy. Okay. And we can talk about the credit markets and stuff. The credit markets aren't pointing to a direct recession. They could be pointing to a slowdown. Obviously, things are already slowing down. But the credit markets, which are usually the credit like bond markets, which usually are pretty keen indicators of evident recessions, are not flashing yet. Okay, so that's good. That was different in the housing bubble. The dot-com bubble, what happened there is pretty much the exact same thing that happened during the ICO bubble. Initial coin offering in 2017, 2018. Okay, if anything, put blockchain in their name. If you made any crypto project with a half-ass, or I should say half-ass, half-decent white paper, if it was half-decent, glass half full, if you could make a decent white paper or just convince people that you were in the crypto space, everything was going parabolic. So the dot-com bubble is a lot more like the ICO bubble, where pretty much so many of the projects, 99% of the projects that just popped up in 2017, 2018, similar to NFTs today. 99% of NFT projects are probably going to go to zero. That's what happened during the dot-com bubble, is the fact that like you put .com at the end of your name if you're a public company, and you were going to go to the moon, right? Just because everyone wanted to get on that train. But there weren't actually companies. Similar to the ICO bubble, similar to NFTs, there is the belief that this could be valuable someday in the future, and you can offload this to someone who believes the same thing for a higher price at some point in the future, which can happen during the bubble itself. But once the bubble pops, everyone realizes, oh shit, there's no actual underlying value, there's no economic output of this underlying asset. And that's the difference, okay? So that's what happened in the dot-com bubble right now. Like, Snapchat is a great company. Snapchat is a good company. Facebook, which tanked today, is a great company. Tesla, although I've been shorting, is a great company. Apple's an amazing company. Unity, Roblox, SoFi, the stocks that are near and dear to the portfolio, those are great companies that are getting overly beaten down because, once again, people are running out of money. And again, to close it out, we are in extreme fear. We just, from a historical perspective, it's unsustainable to be extremely fearful for a prolonged period of time. And I do think we need to reclaim levels of standard fear. And I do think short term, the equity markets overall, especially growth stocks, especially small caps, are due for a bounce. And I'm excited to see what happens in the future. But again, maybe tomorrow isn't, maybe when you guys are watching this, the market's down again. But again, this just can't last for for much longer, simply because it's unsustainable and it has not been seen before. Okay, so that's the video, you guys. Again, if you want to know how I'm trading on a daily basis, go check out the free 7-day free trial. Let's say that one 7 times fast. 7-day free trial. First link down in the description below. And I'll talk to you guys in the newsletter tomorrow. If you're part of the Waves fam, upper tier of the Waves fam. If you're part of just the YouTube fam, that's all good. Appreciate you watching. Give the video a like if you're still watching. Greatly appreciate you if you're watching to this point, to the rambling points. Give the video a like. Let me know in the comments down below what you're thinking of the current market environment. If you're buying right now, if you're unfortunately selling right now, let me know, and let me know why. And I'll see you guys downstairs in the comments. Till next time, always remember, take action, make waves. Peace.